Single stock futures, SSF, are financial derivative contracts that represent an agreement to buy or sell a specified number of shares at a predetermined price on a future date. These standardized contracts are traded on regulated exchange, and their value is derived from the underlying stock listed on the stock exchange. Single stock futures is listed on Bursa Malaysia derivatives, with each contract representing 100 units of the underlying shares. A key advantage of single stock futures is the ability to take a short position when anticipating a bearish outcome, such as an earnings downgrade or company-related events. Trading single stock futures only requires a fraction of the total contract value as margin, thus making it a capital-efficient instrument with reduced trading costs. Furthermore, single stock futures offer various potential trading strategies that enhance both overall risk management and return potential. Single stock futures are commonly used as a hedging tool to protect against a decline in stock price. For example, suppose an investor holds a position in Company A's stock and fears a drop due to a negative earnings announcement or bearish market sentiment. The investor can sell a single stock futures on Company A stock as a hedge. By selling or shorting the single stock futures, investors tend to gain from declining prices, which will offset some of the losses experienced by holding the stock, thereby limiting the losses the investor faces. Beyond hedging, investors can utilize single stock futures to express a view on stocks. Suppose an investor is bullish on a company due to positive prospects or better than expected earnings results. In that case, they can purchase a single stock futures with a lower margin. For example, if Company A price is currently trading at 7 ringgit per share, a single stock futures on Company A will cost 700 ringgit, since one contract equals to 100 unit shares. Instead of putting the full contract value, investors put up a fraction of the total value as margin, and in this case, the margin required to hold one single stock futures of Company A will be 250 ringgit. An investor can sell single stock futures on stocks expected to show poor earnings performance or negative company developments benefiting from the price decline. Investors can also utilize single stock futures in a relative value trading strategy. This strategy seeks to identify two similar companies operating in the same industry that differ in their respective values. Suppose one stock becomes overvalued compared to the other. For example, if Company A traded at a higher valuation compared to Company B. In this instance, investors can sell a single stock futures contract on Company A, the overvalued company, and purchase a single stock futures on Company B, the undervalued company, expecting their relative difference in value to narrow in the future. However, investors will face potential losses with this strategy if the relative value widens rather than narrows. Since single stock futures contracts are traded on the futures exchange, while the underlying stocks are traded on the stock exchange, there may be instances where prices for both single stock futures and the underlying stock diverge. If such a scenario arises, investors can capitalize on the arbitrage opportunity by buying the cheaper listed product and selling the more expensive product, generating a profit for the investor. In conclusion, single stock futures generate numerous trading opportunities for the investor and is a leveraged instrument that greatly enhances return and amplifies risk. Thus, investors should approach the instrument with adequate knowledge and understand the inherent risk. Get bullish about learning.